Good morning and welcome back to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Andrew McOrmond with the ETF Trading Solutions at WallachBeth. Thank you very much for joining us over and for our monthly conversation on ETF trading trends. Let's talk about one of the fastest growing segments of the ETF products is insurance companies issuing ETFs. You would think not many people associate asset management decisions with insurance companies, so tell us more about that.
Yeah, I think it's really interesting. I mean, they've been using ETFs for years, but I think why it's relevant for our conversation is you see so many people will either watching your channel or looking at the Nasdaq or at home, and then an ad comes out maybe and says, wait, I thought they issued my car insurance or my home insurance, and they have those products. So I think what's interesting is some of the smartest brains in the business actually work for the asset management divisions of these insurance companies. Take USAA, for example, right? That's the military insurance company. And they've always had some of the smartest, and if you think about what their motto is, to protect the military and their families, they employ the same principles in their investment. So they've employed some really smart people. They have a product, USVM, which is a small cap product, and I would put that against any small cap manager, but maybe more even important for the retail audience when you think about the use of ETFs. It's a small cap ETF. Small cap stocks have a tremendous amount of single stock risk, so a way to mitigate that risk is to put the money into ETF. The other leading issuers have, insurance companies have done it as well. Transamerica, Principal, TIA, CREF, Nationwide have all come out with these products, and I think it's really interesting. The general accounts, meaning the money that you're putting in for your premiums, are beginning to also use ETFs. They obviously don't issue ETFs with those with those dollars, but they're using fixed income ETFs for cash parking purposes.
All right, another product that's picking up steam. We all know what levered volatility products are, but now you're seeing levered index.
Right.
ETFs.
So that's the 3 times and 2 times ETFs that have been in and out of the news depending on the time. One thing we always are careful suggesting those to individual investors and making sure they're reading up on what the product is. So traditionally, for this product, people have known they're 2-3 times leverage. Oh, I get 3 times exposure to this index or that index. In this market, that's a very scary product because it's a choppy market, right? If you happen to pick the right direction, triple long or triple short, then you'll be good, but you still want to be careful how long you own it, right? Direction has come up with a product, PPLC, that's a 1.25 times levered ETF. That's been out for a little while, but it's really gaining traction because of this market, because it mitigates the choppiness that's taking place in the market. Has 2 effects that that I can discuss with it. Obviously, you're getting alpha. It's 1.25 the exposure to the S&P, so that's great. People like that. But a thing that people don't think about is they can use about 80% of their money, because there's trading costs with the holding ETF and management fees. They can use about 80% of the money, put it in that, get exposure to the S&P 500, and then use the other percentage of the money to do an alternative investment.
Well, here's my question when it comes to the levered products, and I think part of the press around the levered volatility ETFs is people look at them as a way to hedge your portfolio, when in fact, it says in the prospectus, these are intraday, perhaps an overnight trade.
Correct.
These are not stock per hedge kind of vehicles. These levered index ETFs, can they be used as a longer term hedge, or do you run the same risk that the vol products have?
Well, so but it's 2 things. The 1.25 I like because you can do long term. They are, most of the levered products, and the vol we'll touch on in a second, are designed to be a daily product, right? And you need to read to make sure you want to hold that for a long period of time. With the vol products in particular, many of them are ETNs, and it's important to notice the difference between ETNs and ETFs, right? ETFs are backed by something, whether it's stocks, futures, gold. ETNs are notes with a credit risk. So make sure you divulge into that. And the volatility funds, just like if you think about a levered volatility fund, right? It's volatility resets and leverage resets. So there's a lot to that product. I think one of the tips we can give the audience is to understand that every one of these issuers, unlike a single stock, has what's called a capital markets desk. So first, say you could call Directions Desk and get advice and clear answers on how and when to use these products. We can always say make sure you read the prospectus, but a lot of people get lost in that language. So I think it's important to know that these desks have capital markets desks.
All right. Well, thank you very much for joining us at MarketSite. We'll see you next month in May. And thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.